Okay, so here we go with question 5 from the Chapter 7 homework. I know the framework did not include the opportunity to use to show the recording of transaction 3 and 4, but I just built out this spreadsheet. You could have done that on pencil and paper just to kind of see how those other transactions are kind of coming together there to answer the questions that we have here. So our net income. So what is our net income for the period? Well, if we go back over here to our framework, we can see that we have our revenue of 93,000, and if we subtract off our interest expense as well as our operating expenses, we would see that our net income for this particular period is $25,410. So our revenue for this particular period was 93,000. Our expenses were 11,790 plus the 55,800, and our net income is 25,410. Our operating cash flows. What was our cash flow from our operating activities? Well, we can look at our framework again and just pull in those couple of items. We had a positive inflow, cash that we would receive from our customers. We had a negative going out for our interest expense. We also had a negative going out for our operating expenses. So our operating cash flows was 25,410. Again, our inflow from our customers was here, our revenue at 93,000. Our outflow for our operating expenses was our interest as well as our other operating expenses. So the grand total again of those two items is 25,410. Our financing cash flows. Well, let's go back to our framework again. We had the money that came in when we borrowed the money. We also had the money that went out when we paid our first principal payment on that note payable. So our financing cash flows was a positive of 110,777,000. We could also look at our inflows from debt and our outflow, our principal payment on our debt, and the grand total of that again is our 110,777. All right, very good. Let's work then on question 6, which is let me toggle back to here. What is the amount of interest expense on this loan for 2021? So again, we're given this amortization schedule that showed us that our principal was 110,777. We paid 34,193. We had interest, we had a principal, we have our ending principal. So what's happening here is if we walk through this amortization schedule for the year 2021, our beginning principal is going to be what we ended 2020 with. And our full payment's going to remain the same, 34,193. The interest, remember in the first video, in one of the previous steps, we calculated that the interest was 9%. So if we take 9% of the beginning principal, that's going to tell us that we had $5,414 in interest. That means that the rest of this payment is all principal. So then our ending principal is what we began with, minus the principal that we just paid to give us our new ending principal. So the question here was, what is the interest expense for this particular year? Here we are with our interest calculation for 2021. Again, we're looking at 9% of the beginning balance, that's $60,151. All right. Let's then take a look at question 7 on the homework. Let me toggle over to that. For that particular question, we have 3 different scenarios that we're looking at, and we need to determine if there's a premium or a discount. Okay, so really what we're saying is that we're comparing the stated interest rate, the rate on this bond, and we need to compare that to the market. If the rate on this bond is greater than the market, then we get to charge a premium. If the rate on this bond is less than the market, we need to sell this at a discount to try and entice people to buy this. So let's take a look at the first example. This company issues a $400,000 in bonds with a stated interest rate of 7%. At the time of the issue, the market rate of interest for a similar investment was 6%. So the rate on our bond is 7%. The market rate is 6%. We're paying more than the market. So that means that we will get a premium on this particular bond because we're paying more. If you were to buy our bond, you would get 1% more than the other bonds that are available on the market. So we are going to have a premium for this particular bond. Okay, so let's take a look at the second question. Spring issued $200,000 of bonds with a stated interest rate of 6%. That's our bond. And the market is 8% for similar bonds. So that means that the market is more. That means that we're going to have to offer a discount to try and entice people to buy our bond, which is not paying as much interest. So we are going to have to pay, we're going to have to offer this bond to the public at a discount to try and get them enticed to buy this particular bond at this time. They can go out and buy a similar bond and get paid 8%. So in order to make up for this interest rate difference, we're going to sell it at a discount. Try and, kind of do like a fire sale. Try and increase the demand because the pricing, the interest rate is such that otherwise people wouldn't be interested in our bond. Okay, let's take a look at our last one. This one, it gets a little exotic, but we're after the same idea. Our bond versus the market. River issued 150,000 of callable bonds with a stated interest rate of 6%. 6%. Market for a similar bond is 7%. Okay. We can ignore the fact that this is a callable bond at 102, that there's these other facts and circumstances. All we really care about is that our bond is less than the market. So how are we going to sell this? Well, we're going to have to offer it at a discount again to try and entice the public to buy our bond. So we're going to have to offer that at a discount to make up for that interest rate difference that we're short. So we're gonna try and entice people to buy our bond by offering them that discount there. So that's it for question 7. We'll take a break here, and we'll do 8, 9, and 10 in video 3. So please click and view that, and we'll keep rolling from there. Thank you.